Hey, it's Carol and Tim.
And we have something new and exciting for you.
Everything you love about Bloomberg Radio is now in your car.
The new Bloomberg Business app, now featuring Apple CarPlay and Android Auto.
Listen to your favorite Bloomberg radio stations anytime.
Plus, every Bloomberg podcast, the latest news and more, all at the click of a button.
It's free and simple to use. Just download the Bloomberg Business app on your smartphone and connect your phone to your car.
The Bloomberg Business app, now with Apple CarPlay and Android Auto features. Download it free in the Apple App Store or on Google Play.
Presented by our sponsor, Interactive Brokers.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Well, it's finally here, an end to the historic 118-day strike, but who's counting? That halted TV production, it delayed movie releases, it shut down much of the entertainment industry. Hollywood studios and the union representing some 160,000 actors have finally reached an agreement on a new 3-year contract. Remember, the writers who went on strike back in May have been back on the job for about a month. At the same time, we did see shares of Disney rallying. We heard that from Charlie Pellet after the company reported better than expected profit and vowed to cut $2 billion more in expenses. For an update on all things Hollywood, we turn to Thomas Buckley, entertainment reporter here at Bloomberg News. Tom joins us on Zoom from our LA bureau. Good to have you with us this afternoon. Give us the details of what we know, because there are still some details to be hashed out, which is my understanding, of what we know about this new deal that ended the actor strike.
Absolutely. Well, great to be here. You were suggesting who's counting. We've very much all been counting over the past 118 days. For this to come to a resolution, it looks like we're very much there now. So late yesterday, the negotiating committee of the SAG-AFTRA union approved terms that were put to them by the studios and have recommended those to the board. There'll be a board meeting tomorrow to ratify the deal. And my understanding at the moment is that the increase in the terms of the overall deal add up to about $1 billion. So it's a very significant win on the actors' side, it looks like. They also sought very robust protections as it relates to the use of artificial intelligence concerning the actors' likeness. So more details of the deal will come out tomorrow once it's been ratified by the board at the meeting.
So, Thomas, you're saying this is a win for the actor side, but we see Disney stock up substantially in a down market. Obviously, this has to be a positive, and that's before we even start looking at Netflix or Apple or Amazon, anyone else with an interest in this. Why did this take so long to reach this agreement? Was this a win-win?
It's a very good question. I think it certainly is a win overall for the town. I mean, Hollywood has been desperate to get back to work ever since the writers walked off the job back in May, seeking better terms in their own contract. The DGA, which represents the directors, was able to get more favorable terms, and there was no need for a strike there, they argued. And then the actors themselves walked off the job in July. And since then, the vast majority of Hollywood productions, be they TV or film, if they're not independently produced, have been shut down. So that's impeded really a ton of titles from progressing over the summer and ended up imperiling much of the autumn season for TV and the blockbuster season as relates to theatrical films for next year. So I think there is an immense sigh of relief that everybody can now return to the job really as early as today, given that the strike on the actors' side ended at 12:01 last night. I think that the reason why we're also seeing Disney stock up is obviously that they had decent results yesterday, which is really driving a lot of the equity story there today.
Yeah, I want to talk more about Disney in just a few minutes, Thomas, but I want to make sure we hit every constituency here. So we just had Barry ask you about the companies. You talked about the workers. What about people like me who, after a long day at work, want to go home and stream something on Hulu, Netflix, or HBO? I guess I got to call it Max now. I'll still call it HBO, though. What happens to the release schedule of everything that was kind of put on hold over the last few months? When does that start to trickle out and hit the platforms?
Well, look, it's going to be very interesting to observe that. I mean, certainly on both the streaming side and on the theatrical release side, a number of people are going to be playing around with their schedules, maybe seeking better dates to accommodate productions that are going to be wrapping up later than planned, and really strategizing around what are the best titles to put out either as soon as possible if they're complete, those that will benefit from being promoted by the actors in them. There's going to be a number of conflicts, I think, certainly in trying to get actors both promoting existing titles and also shooting upcoming titles. So it's going to be very interesting to see how that plays out. I mean, even as early as yesterday, we saw in the immediate aftermath of a deal being announced, Sony moved their Venom title by a few months. And I think it remains to be seen exactly what the film slate looks like for next year on the basis that it's not necessarily fixed. I think a lot of studios will still be evaluating whether the current dates they've set for their titles still make sense for them.
So what do you make of what's been going on in the movies that have been out? We've seen some giant blockbusters. You had Oppenheimer, we had Barbie, we had Top Gun, and now the new Taylor Swift movie. But between those tentpole films, it's kind of been a vast wasteland. What does it say about the future of cinema as entertainment?
It's a very good question. I think, you're totally right to say that obviously there were some huge blockbusters over the summer with Barbie from Warner Brothers and Oppenheimer from Universal really being standout films. Certainly as it relates to Barbie, that was, about $1.4 billion in box office receipts, which is really, Warner Brothers' most successful film in its 100-year history. So the summer hasn't been without success stories. That being said, as you rightly point out, since then, it's been a little bit of a drier affair. And I think that without the actors being on hand to promote the films either in press interviews or at red carpet premieres, it's been very difficult to build up the amount of buzz that's needed for these films to really travel properly.
So I want to go to, really thinking about the potential long-term effects of this. Were there any habit changes, or will we know if people change their habits as a result of I think this is more about the writer's strike and less about the actor's strike. But given that we had, and it's all a similar labor story, Thomas, but given that we had such a long break from late night comedy shows, the late night talk shows, a lot of investment went into the reality shows. I'm wondering if we're going to start to see any sort of long-term habit shifts as a result of this, people moving away from watching those things that were off air for so long.
It's an interesting question. I mean, certainly the same dynamic was observed, during the writer strike of the late aughts, back in 2007, 2008.
But there were fewer alternatives then. There wasn't, you couldn't go to Netflix, you couldn't go to Hulu then.
That is certainly true, but nonetheless, you did see a surge in investment in reality TV shows, and reality TV really had its moment, I think, in the back half of that decade when everybody thought, this is where the future is and the money to be made, and it's also a very good insurance policy against future strikes. The truth of it is, I think there's still a huge amount of appetite for scripted content, and as a result of that, people will tend to gravitate back towards it even after a period of reality TV shows. I think the difference, as you very rightly point out this time around, is the sheer availability of existing content on streaming services meant that people actually thought, despite there not being anything necessarily new out this week on the basis there is a writer's strike, I can nonetheless catch up on all the scripted content that I've been meaning to catch up to and wasn't able to over the past couple of years, given that we were still in the tail end of what I suppose you could call peak TV, with a volume of shows that is simply unprecedented for all of us to catch up on.
So Thomas, let's break some hearts and tell some secrets. Reality TV is often called unscripted TV, but those of us who work in the business
say it ain't so.
It turns out to be surprisingly scripted. How were they able to get around a writer's strike when everything you see is edited, manipulated, structured, based on some showrunner driving the narrative, driving the storyline?
So that I couldn't possibly answer on the basis that I'm not on the sets when these decisions are made. That being said, maybe everybody involved in a quote-unquote reality TV show was given their briefing notes and storylines early on in the process and knew exactly which line to track. But that's purely an assumption on my part, and I'm speculating now. So, yeah, with the absence of actually sitting on these sets, I couldn't possibly know.
Okay, Thomas, give me 30 seconds on Disney. I promised we'd save a little bit. You wrote the story on earnings. You were on the call yesterday. We know about the cost cutting. Give us your take day two.
Yeah, it's very interesting. I mean, so Bob Iger has pledged to cut an extra $2 billion out of the business, bring the total tally of cost cuts on an annualized basis to $7.5 billion. And I think that what it really does is it complicates the narrative for billionaire activist investor Nelson Peltz, because it seems as though Bob has really taken an approach now to favor operational gearing, to get the company back to growth. And so I think that it complicates the narrative for an activist investor to come in and say, look, this is what I do differently, because it seems as though at this point, Bob is trying his best to activate from within.
Thomas Buckley, thank you so much for joining us. We love it when you join us. He's entertainment reporter at Bloomberg News. He's in our LA bureau. He knows all things when it comes to the writer's strike that has ended more than a month ago, the actor's strike that just ended, and then, of course, Disney, which he's been covering and writing about throughout the day.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Problems, problems, problems all day long.
Well, until today, we had seen quite a rally in equities over the last 10. As of earlier today, when I wrote this, I should note, stocks were up a whopping 6.5% since October 27th. Our next guest, though, says that the strength of the mega cap stocks is painting a false picture of the health of the market and expects a recession to begin in the next few months. We're very pleased with us. Well, we're not so pleased with us, but I'm very pleased with Doug Ramsey, our next guest. He's CIO at the Leuthold Group. He joins us live in the Bloomberg Interactive Brokers studio. Doug, good to have you with us. I got to tell you, I got a text from a friend this morning. We sometimes talk about investing, and he likes to send me articles. I like to send him articles, and he sent me an article that had a headline that I've been hearing over and over from guests, which is like, okay, enough with the S&P 500. Focus on the S&P 493, because the 7 stocks that are responsible for so many of the moves that we've seen this year are getting way too much attention.
They sure are. I mean, all year they've painted this false picture of the market's internal strength, and that bothers me, especially with respect to the narrative that we've been in a new bull market for the last 13 months. If we were in a new bull market, and there's always a chance, but you'd expect to see the average stock trumping the relative safety of the broad cap-weighted averages. You'd expect to see the Russell 2000 up 50 or 60% from its lows, and it's hovering here after the setback we've had the last few days here, 2 or 3% above its bear market lows. It's just not bull market action, and I think, the smaller stocks are more credit sensitive, so it stands to reason they would start to respond to the tightening in financial conditions first.
So here's the pushback to the criticism, and I'm going to play a little devil's advocate here. Hey, the Magnificent Seven, as people like to call them, $1.8 trillion in revenue, $250 billion in profits. They're best positioned to put AI into place, and this is the biggest, call it a super cycle, a platform, whatever buzzy word Silicon Valley likes these days. It's the next internet. How do we contextualize those, Microsoft and Apple and Google and Facebook, those companies' ability to use this new technology and profit from it?
As businesses, I think the bulk of them are going to do fine. I mean, the issue is they may have to grow into their price tags. And I mean, unlike 2000, I mean, these are much comparably bubbly valuations, but much bigger companies. So just, the law of large numbers is going to hit them more so even than it did like a Cisco back in 2000. So I think they're going to do fine as businesses. And if we have a recession, it may even buttress their businesses like it did during the shutdown 3.5 years ago. And I think, so there's sort of some reflexive buying of those stocks and owning of those stocks because of that memory of how well they did during the shutdown.
You're saying they're the new safe blue chips?
Yeah, exactly. When you look at, the behavior of consumer staples, obviously a lot of that is the Ozempic effect. But yeah, I think they're sort of a surrogate for cash for these big portfolio managers that must remain fully invested.
What are your concerns about the economy? What leads you to think that we're going to hit a recession in the next few months?
I'd love to say it was some penetrating statistic deep in the Federal Reserve archives, or different ways of looking at liquidity, but it is really the traditional stuff.
Like meaning a recession is a natural part of a business cycle?
The yield curve inversion, and both it's, people tend to say, they tend to look at the yield curve in a binary way, if it's inverted bad, if it's uninverted good, but it's the depth of this yield curve inversion. As a matter of fact, it's sort of re-inverted. After a lot of uninversion, a lot of moving towards zero, it's sort of re-steepened again. But I just think every day that negative spread between tens, and we like to look at the 10-year minus the 3-month. We also like to look at the near-term forward spread, both extremely deeply inverted. That is just hitting the economy every day, and it clearly it's hitting the mid and the small cap stocks, and even the equal weighted S&P 500 down on the year.
What do you think of that? Can we ignore that inversion?
So it's I agree that it's not just. I agree with Doug. It's not just the depth; it's the depth and the duration.
Yeah.
We've been inverted for a long time. Although, if you look at the academic research, the recession happens once the inversion unwinds, and then I think it's about 150 days after.
But there's also a mixed record. The last recession that we had at this point was during the coronavirus pandemic, and there was an inversion in the yield curve before that. But that recession was completely unrelated to.
Well, we don't know what would have happened without the coronavirus. The problem with the yield curve, the two big problems with the yield curve inversion as an economic indicator. One is it's been 8 for 8, which is perfect, but 8 is a very small sample set. And when we go out of sample, when we look at Europe, it's much less a reliable forecaster. Now, different economies, different sociology there. People tend to stress much less because, hey, they have health care. If there's a recession, they get laid off. They don't care, nationalize health care. So maybe that's why it doesn't work there. I'm just spitballing a little bit. But it's kind of tough to look at. Is the yield curve an indicator of recession, or does it, as Doug implied, cause a recession because of that inversion?
Yeah, and I'm in that camp, and I'm even in that camp. And now here's something I'd like to see confirm that, I should say, is a weaker stock market. Like right now, the stock market on a trailing 12-month basis is too strong for a business cycle top to occur right here. So we did this research. We basically asked, okay, what did the stock market do, S&P 500, do on a 12-month trailing real basis leading into the business cycle peak? And the answer is that on average, now excluding 2020, again, that was a different animal, but on average, the S&P 500 was down in real terms 10% at the previous 8 business cycle peaks. And it was flat or down every single time. And then I think it was up like 3-4% at the February 2020 business cycle peak. So I'm sort of saying the best thing the market's got going for
is the market.
Well, is the market and the economy. And so when we do get to where stocks are roughly flat to down year over year on a real basis, that will be the negative wealth effect that is sort of the final straw that breaks the camel's back.
Okay.
Go ahead, the last thing I wanted to ask about is when we're looking at the economy, and I know these can just fall right off a cliff into a recession. GDP, all right, that's kind of a one-off number, just under 5%, 4.9. I think we all know this is really a 3% GDP economy, not a 5%. But unemployment has remained very low. We're pretty close
to 4%.
Right? We're pretty close to 50-year lows. People have been getting wage gains. Inflation seems to be moderating dramatically.
I've heard the word. I didn't hear the word Goldilocks coming out of your mouth. But
well, the reason it's not Goldilocks is a combination of how unusual it is coming out of the pandemic, and then all of the geopolitical turmoil. How do you work that into your model?
Well, just a couple points. First, with regard to the unemployment rate, this would be like the unoptimized version of the SOM rule.
Yep.
The unemployment rate has ticked up 0.5%. And that's always the old school rule of thumb, not the moving average calculation. But that's confirmed 8 of the 9 last recessions, not forecast them, confirmed. And as a matter of fact, in 4 of the 8 last recessions, that uptick of half a point in the unemployment rate was the exact month of the business cycle top. And then 2 of the remaining 4, it lagged by 1 month. So if you were going to try to call around close to in real time the peak in the expansion, I would propose a half point increase in the unemployment rate has been a pretty darn good one.
3.4 to 3.9. There's your half point.
Yep.
We already have it.
Yeah, it's happened. And then I think it'll happen with a 3-month moving average triggering the SOM rule next month.
We got to get you back soon to see where things are. Check the progress here. Doug Ramsey, CIO at the Leuthold Group. He's with us here in the Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We should talk about something, what we learned about fund managers from Bank of America, Barry. Active fund managers focused on large cap stock trades notched their biggest hit rate in 2 years last month. Are you an active manager?
Not really. I mean, we're really an asset allocator. We own broad swaths of value investing, emerging markets, broad indexes. The only thing that we do actively is tax loss harvesting, although we're not a pure passive manager because there's no such thing. If you have, are you equal weight to the global market? Probably not. Are you somewhat overweight to the U.S. market? A little. You know, when you look around, you have to make some sort of decisions. But for the most part, we want to allow the market to work for us rather than think we can beat the market, because the data says after 10 years, 99% of active managers fail to beat their benchmark net of fees. Why do I want to play for the losing, 99%? I would rather get what the market gives me. You do that consistently over 20 years, and you're in the top quartile of returns.
And you know what? Still, there are so many people who think that they can go out and beat the market each and every year. And we love them because we love talking about them here on Bloomberg. And also, I think it makes a market.
I have a personal cowboy account, and we recommend this to people who have that itch. They feel that they can pick stocks or time sectors or, trade options or whatever it is. Take a couple of % out of your liquid portfolio, set up a goofy account, and have at it. Hey, if it goes up 20x, that's fantastic. The reality is that if it was all your money, you would never have the patience to let it do it. And if it crashes and burns, hey, it's 2%. Who cares?
Well, we got Alexandra Semenova in here with us right now. She's equities reporter at Bloomberg News. She writes Taking Stock quite frequently. Check out today's Taking Stock because it's really interesting. It talks about the more than 2/3 of U.S. mutual funds with a bias toward bigger market caps outperformed the broader Russell 1000 benchmark in October. They had kind of a secret, though, Alex. What was their secret?
Yeah, so it's great to be on with you guys. Thank you so much for touting the column, Tim. We really appreciate it. So large cap managers did post their best hit rate in 2 years. That is the percentage of positions that have generated positive returns over a given period. And this happened for 2 reasons. The first is because they had a bias toward large cap stocks within the Russell 1000 index, which held up better during last month's rout. And then the second is because they steered clear of Tesla. Sometimes avoiding a stock could really be the deciding factor in performance, and that was really the case last month because Tesla was down 20%, making it the biggest detractor from benchmark performance over the period.
So that's the key phrase there, benchmark performance. I have to ask the question, how much of this hit rate is that these, I'm using air quotes, active managers are really closet indexers?
Yeah, I mean, what you were saying earlier is really interesting because everyone is talking right now about how it's the time to be a stock picker, right? After the massive rally that we had in the first half of the year.
It's always the time to be a stock picker,
if you're a stock picker.
Right, I mean, we hear that every quarter.
If you're really good at it.
Right.
But, after this massive rally, there's a lot of uncertainty about the staying power of equities for the rest of the year and into 2024. But the S&P 500 is still up 14% year to date.
And here we are, 10 months and change. 14% is a good year.
Right.
Forget if we even get a Santa Claus rally, who knows what it's going to look like. That said, we know the equal weight S&P is negative for the year, and the Russell 2000 looks pretty ugly. So it seems to be big cap or nothing these days. That's probably why these active managers that lean big did so well.
But why are they steering clear of Tesla right now?
So that's a good point.
Because a lot of the run-up that some of the active managers had was because they took an early position in Tesla, and that thing turned into an oak tree.
But when everybody figured out it was going to be added to the S&P 500, they front-ran it.
Yeah.
But the question is, and this is my question, what is happening now that there's competition from other hybrid and EV manufacturers, and what has his ownership of Twitter done to his
Barry,
EV buying fan base?
It's called X now.
I think a lot of, as we're seeing, there are a lot of ex-owners of Tesla.
Yeah, I think you're right about that.
Well, before we get into Tesla's most specifically, I do want to point out, because you guys mentioned that before it was just focusing on these big caps, which have obviously outperformed other names in the market. But now, even within those names, we are starting to see a divergence. So before we had AI euphoria, everyone was really confident that we'd get a soft landing. And so these companies were moving in lockstep. And now there is focus on these individual names. And you can see that in the performance last month, with Tesla being that massive detractor, while some of the other mega caps did hold up much better. And of course, Tesla's problems have to do with the fact that there's uncertainty now about demand for electric vehicles, given macroeconomic uncertainty broadly. Of course, there are issues with Elon Musk's ownership of Twitter and how he's handling that company and whether he's taking away from Tesla. Today, specifically, Tesla got a downgrade from HSBC. They specifically pointed out their concern about delivery timing on the cars. They also said something really interesting. They said that Elon Musk is pretty much essential to the company, but also a risk.
So that's fascinating. HSBC is saying that if you manufacture EVs, owning the libs on social media is a bad strategy. Is that?
Apparently, that might be.
Who would have guessed?
Who would have
the
thought?
case.
Hey, Alex, what else did you learn from this from Bank of America here?
Yeah, so just that investors are really paying much closer attention to company metrics. They're looking at company fundamentals and growth prospects, and the growth prospects for the Magnificent Seven are actually at an all-time low. So we've seen this year, this massive earnings rally, and next year we're not so sure that it's going to continue into 2024.
Do we ever really know what next year's earnings are going to look like? I love the uncertainty meme. I'm pretty certain I have no idea what's going to happen.
You got 10 seconds, Alex.
I don't envy market forecasters. Obviously, we've been in a really topsy-turvy market, and it's going to be interesting whether the bulls or bears are right in the final less than 2 months of trading.
All right, Alex Semenova, equities reporter at Bloomberg News. She writes about it in today's Taking Stock. Everything we talked about just now. Check out Taking Stock, though, each morning on the Bloomberg terminal. You're listening to Bloomberg Businessweek. Tim Stenovec and Barry Ritholtz in for Carol Massar this afternoon, and this is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, well, it's hard to believe it is that time already. We are just about 14 minutes away from the close of U.S. trading here. As I mentioned, the NASDAQ is in the red, down about 1%. The S&P 500 down close to 0.9%. The Dow down 0.7%. It's time for us to drive to the close. We got Nancy Tengler, Chief Investment Officer at Laffer Tengler Investments. She joins us on Zoom from Arizona this afternoon. Nancy, we should note, also the author of The Women's Guide to Successful Investing. It's good to have you back with us, Nancy. How are you?
I'm good, Tim. How are you? Thanks so much for shouting out the book.
Yeah, of course. We're doing pretty well here. So I wanted just to get your thoughts before we get to your bigger macro thoughts about what's going on. Just give us your reaction to what we heard from Jay Powell over the last 90 minutes or so.
Yeah, I listened to the previous segment, and that's a smarter crowd than I am. I've been really actually disappointed with the Fed's rhetoric from the get-go. I mean, let's not forget, this is the third bear market that Jay Powell has presided over. The first one was when he spooked the markets in October of 2018. He doesn't get credit for the COVID one, nor blame at bear market. And then we had, last year. And so it just astonishes me that the market sort of, breathes a sigh of relief when they're dovish, and then the next day someone comes out hawkish, and we get this, the same kind of reaction. And yet, at every turning point, not only has the dot plot been wrong, but a lot of the chairman's policies have been wrong, and things that he has said at one point turn out not. I'm not even thinking about raising rates. It won't be 75 basis points. It's 75 basis points. It's transitory. This data-dependent Fed, I think, has created a lot of problems that we could have avoided. So he may be being transparent, but I don't know why the market continues to react to every morsel that comes out of this committee and the Fed chairman.
Nancy, Barry Ritholtz here. It was transitory. Transitory just took much longer than any of us expected.
Isn't everything transitory?
Right?
Barry?
I mean, in the long run, it's that's the Keynes quote. In the long run, we're all transitory.
Exactly.
But really, I think I take your criticism as they have been late every step of the way. They were late to get off their emergency footing. They were late to recognize inflation. They were late to begin raising, and now it feels like they're going to be late to recognize that they're done and could tip us into a recession. Is that your criticism, or what is it specifically?
It is that, I think, Barry. And, I look at this market as an analog to the 1990s. I was managing money then. Not only was I alive, but I was managing money. And there's a lot of similarities. But in this environment, the Fed's backward-looking focus on data, I mean, we can't do that as portfolio managers. We can't say, earnings were good last quarter and then extrapolate that out to infinity necessarily. I mean, we have to be looking at everything that's coming down the pike, and I don't think they're doing that. I mean, one of the things that I think they could be paying closer attention to is some of the inventory data. We've seen a real surge in inventory. If you look at the S&P, and this is Brian Reynolds' work, not mine, you look at the S&P 500, median days of inventory has shot up to 78.5 days, up 21% in 3 years. So if you have that kind of inventory, inventory turnover is slowed, I think you have to anticipate that that's going to be at the very least disinflationary. And yet we're hearing these, responses to one day of data backward looking. I mean, God forbid we get a bad CPI number, because who knows what we're going to see next week. But I think it's they've created volatility. Powell's unwillingness to kind of at least go to Congress and say, hey guys, why don't you stop spending? I mean, he's only half of the equation, right? And yet there's no mention. It's not our business, but Volcker did it. Greenspan did it. And I think there needs to be some acknowledgement that the spending is really keeping inflation sticky.
Really fascinating.
Nancy, I want to get your thoughts and just transition a little to where you see opportunities. So move from the macro to the micro a little. You've got some really interesting companies that you're keeping an eye on that you think are doing really great work. I want to start with Starbucks right now. It's a company that's gone through a transition. I think it's fair to say. It's a company that wants to, make a lot more coffee in a lot more places, even though it feels like wherever you go, there is a Starbucks already. Talk to us a little about why you're seeing there a lot of opportunity with Starbucks right now.
Cheers. I just had a sip. I think Laxman is, and by the way, I'm going to call him Laxman because I haven't quite mastered his last name yet, but I think he has a lot of levers to pull. He understands that. He's come in, set reasonable expectations, and he's delivered on them. And that's always tough for a new CEO, especially in the shadow of Howard Schultz. But, interestingly, I write about that in the book because I actually first bought it for myself in 2007 after Schultz had left and they kind of saturated the market. And
left the first time.
Yeah, 45.
Okay.
That's right.
Okay.
45 to 30. And I thought I was a genius because it immediately went up like 20%. And then we got the great financial crisis and the stock traded down to 7. And I should have bought more. I didn't, but I did hold on. And since then, the stock's returned about 14% annualized versus the S&P around 8.5 annualized since 2007. So it is a great company that has a history of being able to turn the corner. I think the China story is going to be critical. They actually saw some pretty decent growth in China. They fit one of our themes, which is old economy companies that are embracing digitization. They've got 75 million users, digital users, and that really drives margins. And they are really focused the labor problems have improved somewhat, and they are really focused on innovation and margin improvement. And I think from here, the stock has an opportunity to be, once again, a great growth company.
So not a surprise that the stock got shellacked during the lockdown period when people couldn't get to their local Starbucks. But we've really only recovered about half of that drop from, let's call it $1.25 to 75. We're now a little over 100. What's it going to take for Starbucks to clear that prior high and start trending upwards on a consistent basis again?
Yeah, and by the way, we got out, I think, right before COVID because it just got too expensive for us, and then dipped back in. I think they've got to be able to prove that they can grow in China in a sustainable fashion. They have to improve delivery times and product innovation. And I think, and then the labor question, it was like a triple threat. You had China breaking down, you had COVID, and then you had labor problems. And I think if he can smooth those edges, I think the company, he's talking about 15 to 20% earnings growth, and I think they can get there. I mean, at some point, pricing goes away, right? I mean, I just paid $7.50 for the Starbucks. Wow. I'd rather have a Chipotle burrito.
Where can you find a Chipotle burrito for $7.50? That's what I want to know. That's half a Chipotle burrito for me.
Right. Chipotle, though, is going to be 3 times the size of whatever you're getting from Starbucks.
That's a good point.
What's the next innovation? What's the next pumpkin spice latte that's going to drive sales for them?
Yeah, well, I mean, that's the question, right? I'm going to leave that to them. But they have the cream cheese latte in China. So cream cheesecake, I think, is what they call it. So who knows? But I do think that the cold brew pivot really, and cold drinks in general, has really driven growth. And they have to solve the in-store question as well and increase drive-thrus, which is really what Chipotle did for Chipotle. Even though Starbucks is ahead of Chipotle on that particular metric, they really need to just keep these smaller stores driving through, because the sitting around and becoming a community Starbucks is a bit of a thing of the past.
And I'm going to assume you're not buying into the whole Ozempic is killing Starbucks, Doritos, and McDonald's theme, or is there anything there?
I don't really think there is. I mean, in the 90s we had fen-phen and people stopped eating for a while, but I understand that this is a lifestyle drug too, but a lot of the people that I know that are on it are people that had gastric bypasses and then managed to gain the weight back anyway. So I think those old habits die hard. We own Pepsi. I start my day with a handful of Cheetos every day.
Is that the secret, Nancy? The breakfast of champions? I've never heard that.
It is so good. In fact, at my firm they call them Nancy Tenglers because I
orange dust all over the laptop, all over the Bloomberg login.
Hey, Nancy, before we let you go, just want to get some 30 seconds on Amazon right now. Andy Jassy, inheriting this company, I think it's fair to say, from Bezos, and it's been a challenge there. Why are you bullish on Amazon?
I think Andy Jassy got Tim cooked. And we bought Apple in 2013. We still own some, but we've been forced to sell much of it because of the valuation. But I think he had a lot of challenges that he has delivered on. He laid people off. He improved growth in cloud at the expense of Google, it would seem, or Microsoft was the one that really took share, which is our largest holding. But I like all of the aspects of the business. And we sold CVS because we just couldn't wrap our head around the model a while ago. I just shifted the few prescriptions that I utilize to Amazon. It is a dream. And I think they're going to start to take share not only in pharmaceuticals, but in the healthcare space to some extent. So, the business, the retail business, we know that business. It doesn't have great margins. Yeah. The cloud business is still performing. They're employing AI. They're generating revenues from advertising. And I think he's gotten a rhythm as the CEO. The last call was pretty darn good.
Nancy, we're going to have to leave it there. Really appreciate you taking the time this afternoon. That's Nancy Tengler, Chief Investment Officer at Laffer Tengler Investments. She joins us on Zoom this afternoon from Arizona. Nancy is also the author of The Women's Guide to Successful Investing.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.